Hi. We are waiting for a few more participants to join, and then I think we will start. Let's give them a couple of more minutes. Eh, can I ask the participants to just type yes in the chat if you have received the workbook that we'll be using in the session today? Okay, great. Thanks, Shashank. Thanks, Tia. Thanks. If someone has not received the workbook, please let us know, and you will then get it via an email. Thanks. Okay. So we have around 20 people who have registered. We have half the class strength right now. Okay, let's start with the basic, and then I think as people join, they can listen in. Okay, so welcome everyone for the masterclass today. This is in a webinar mode, so right now your mics are on mute, but it would be great if it can be interactive. So if I ask a question, please do respond on the chat box. It helps to understand that yes, you are following the topic. So certain housekeeping rules, the webinar is being recorded and we will be sending you a link to the recording later so that you can see the webinar again. Your cameras are allowed. So in case you type something in the chat box, but you don't get a response, you can switch on your camera and then I should be able to see you and respond. We would be using an Excel workbook in which we will be developing a cash flow waterfall and various debt repayment profiles during the session. And the solution of that workbook would also be shared with all the participants. And any unanswered questions. So if you have any question that you want to ask after the session or during the session which has not been answered, you can always reach out to us at info@yoginfra.com. So I've also typed the address in the chat box. Okay, so let's start. So before we start, can I confirm that the participants in this masterclass know what is difference between project finance and corporate finance? You can type yes in the chat box if you know what is the meaning of project finance and how is it different from corporate finance. Okay. So Rick says yes. Chutan says no. Anyone else? Because this masterclass is more about the concepts of project finance. So it would be good to have a basic knowledge of what is project finance. Anyone else in the class who doesn't know what project finance is? Okay, so just to give you an introduction, project finance is essentially a cash flow based finance. It is specifically for a project. It's a non-recourse lending, meaning if a power plant is being developed or a road project is being developed by a big developer, someone like, for example, Sembcorp in Singapore. So in case the lending is specifically meant for that project, so that's why it's project finance. Correct. So Santi says project finance, the income is generated from the project itself. So yes, that's correct. So the debt repayment is actually secured by the cash flows. So that's why the concept of cash flow waterfall. That's why the concept of cash flow waterfall is really important to understand, because that's how the debt service would be done throughout the project in a project finance transaction. And that's what we're going to learn today. And the second part of the session is also about, like, if you are doing a debt service, there are multiple repayment profiles that are possible. So how you can do those repayment profiles as well. So how you can do sculpting debt payment, what is an EMI principle or amortization principle repayment, what is an equal principal repayment. So some of them you may be very familiar with. So we will go through that as well. Now, cash flow waterfall ensures that each cash flow item occurs in the correct seniority. So in a typical project finance transaction, debt holders are ranked higher than any other participants in the project. So equity holders are are given the last priority, and then subordinated debt or working capital holders are in the middle. So the first ranking being the debt, the senior debt, then the working capital subordinate loan, and then the equity holder. So there is always an escrow. You might have heard of escrow waterfall mechanism or a cash flow waterfall mechanism. So that needs to be modeled in any project finance model so that there's clear visibility that as the time passes in different years or in different quarters, how much cash is available to the equity holders or in the company. So in project finance, a project's cash flow is summarized using a cash flow waterfall. The cash flow waterfall becomes especially important when illustrating debt repayments of many debt tranches with reducing seniority. So, for example, in a very large project, you might have a case that there are 5 debt tranches and all of them may not be at equal priority. So some may be ranked lower compared to the senior debt. So that's when also it's very important to see that whether how these debt repayments would be done. So if you see this figure, this essentially allows you to see how a cash flow waterfall would typically look like during a project operation period. Okay. During construction, it's quite simple. You have to construct the project, so you get funding from debt and equity, and that's how you arrange the funding. There is no surplus cash as such, unless you have some contingency, you might ask for surplus cash. But then really this mechanism is very important in the project operation period, because that's when you would actually start repaying the debt. So you have the project revenues which are incoming. First of all, you would do the operating expenses. There is a small construction also, but it is mainly for very major maintenance or something that you want to do. But primarily this refers to operating expenses, meaning this would be your O&M cost, your repair maintenance, your salaries, your employee costs. So all these are operating expenses. Then you would do the senior debt service. Once you are done with the senior debt service, then you would have to maintain debt service reserve account. Again, very quickly, do people in the room know what is a DSRA account? DSRA? Yes or no? Chat box, please. What is a DSRA account? Okay. Yeah. Okay, good. So DSRA is typically defined as a separate account. It can be either in the form of a fixed deposit or a separate deposit, or it can be a bank guarantee or a manager's check, essentially to secure the repayment of 1 quarter or semi-annual principal. So one principal payment and either 3 months or 6 months of interest. So in infrastructure projects, you would typically see DSRA being created for 6 months of interest and 1 principal payment. So that amount is cornered off, that's blocked either in the form of FDR or a bank guarantee, and which ensures that in case of any cash shortfall in the immediate period, the next repayment and interest payment is ensured. So once the debt service is done, it's always the DSRA covenant is always checked whether it's still fully funded or not. If it is not fully funded, then that needs to be funded again. Okay. And then you have major maintenance reserve account. This account is essentially used for large projects, large infrastructure projects, wherein there are major maintenance happening every 5 years or 10 years or 15 years, right? So that's when you would need this major maintenance, which is accrued over the years. So if a major maintenance happening in 7th year, it is likelihood that you would start accruing some amount from 2nd year onwards or 3rd year onwards and build this reserve over a period of 5 years or 4 years, and then it can be drawn down when the actual need is there. So when we do the Excel, you would also see that example. We have already filled that major maintenance account for you. But yes, to give you a simple example, if you need $100 in year 6, you would build $20 starting year 2. So you have 20, 20, 20, 20. You do 5 installments and you build it up for $100, which can be then drawn down. So that's MMRA. And then subordinated debt payment. So these are the working capital loans or the mezzanine debt or the lower priority loans that you have taken. So that can be short-term loan for 5 years, 3 years, that or it can be a working capital credit line. So if you have cash left after the senior debt service, after DSRA and after MMRA, then you can repay those loans as well. And then you have the shareholder distributions. So shareholder distributions can be in two forms. This can be either as a dividend or it can be as a shareholder loan repayment. I hope everyone knows what is a shareholder loan repayment, SHL repayments, what is unsecured loans or shareholder loans. Yes. Okay. Thanks. So yeah, so shareholder loans and equity, they are in the eyes of cash flow waterfall, they are essentially classified as shareholder distributions. So these would be paid off at the end. So once everything has been paid off, then this comes towards the end. Okay. And also I would want to highlight a few things that you should know in a cash flow waterfall. These are the key terms, because when you were speaking to lenders or when you were speaking to developers, these are the key cash flow items that they would want to check. So for example, cash flow before funding, cash flow available for debt service, cash flow available to equity, and net cash flow. And don't worry, even if some of these terms are quite new, you would get a feel of it once you start working on the Excel file and these numbers would become more clear. But essentially, cash flow after, sorry, this is a typo, this is cash flow after funding. But essentially, this is a quick check that during the construction period, if you need $1 million spread over a period of time, whether you have actually arranged that $1 million for the funding of project cost itself. And project cost may include ITC or DESRA provision. So all the construction, all the costs that are classified as CapEx, they should be funded through debt or equity. So any cash after that, any surplus amount that has been funded, for example, a small contingency of maybe 5% or 10%, that's cash flow after funding. But in general project finance transactions and infrastructure transactions, typically you would say that cash flow after funding would be zero. Basically, we would fund to the extent of what we need for the construction of the project. Then you have cash flow available for debt service. Now, this is including all your operating expenses or operating revenue, operating expenses, less your taxes, less your working capital adjustments, whatever is the cash remaining, that's cash flow available for debt service. Then once so the cash flow available for debt service comes here after your project revenues and operating. So this is the place where CFATs come in. Now, once your debt service is done, once your DESRA is done, once your MMRA is done, you would have cash flow available for equity. So that's here. So once all these items are done, debt service, DESRA, MMRA, subordinate debt, at this point in time, you would have cash flow available for debt service. And once you have paid out your dividends and you have paid out for your shareholder loans, if there's any remaining cash, that's the net cash flow. So as you may be aware that whenever dividends are being distributed, they are limited to the extent of profit in the company. So if your profit in the company is $10 and cash flow available for equity is $20, you can only distribute out 10, assuming 100% of profit is being distributed out. So then the remaining 10 is the net cash flow for the year for the company. So that's net cash flow. So whenever we are designing a cash flow waterfall, it's very important that you clearly alienate the various items, how it is being funded, the waterfall priority is correct, and you identify these various terms, because these 4 terms would be the most common terms used when you discuss your project with lenders or with off-takers, that how strong is the project. Okay, can I ask everyone to open up the workbook that has been sent to you? Once you have opened up the workbook, please type yes. And if anyone doesn't have a workbook, please let us know so that we can send that to you. I see a no here. Doesn't have the, okay. Pradeep, so can I ask, you don't have the notebook, workbook with you? Okay, so we have a couple of people out. Okay, so people, I think people who have may have registered in the last minute may not have received the email. Don't worry, you will have it in the next 5 minutes. That's fine. Okay, so for everyone else who has actually opened the open, can you please open the cash flow waterfall worksheet in the workbook? Thanks. I'll also share my screen. Okay, and guys, I think I've assumed that if you're joining this class, you know, like the basics of modeling, so you understand. So I'm not going to tell you about how to put the formulas and everything, but really the concept on how to prepare a waterfall. So we have already filled some of the cells for you, and the remaining needs to be done by you. Okay. Okay. So let me share the workbook on the screen. So I think there are a couple of people who have not received the workbook. So guys, the workbook has been sent to you. Please check your emails. Thanks. Okay. Are people in the call familiar with these terms? EPC, concession company, IDC, etc. Are you familiar with these terms? Yeah. Yes, no. Okay. Okay. So this is all essentially the capital spend, and this is the terms that you would see in any infrastructure project. In EPC is the hardcore equipment, etc., that you would procure for the project, and the turnkey contracts, civil work, structural work. So that's all EPC. Concession company costs related to pre-operative expenses, pre-development expenses, etc. IDC is interest during construction. So typically, if you're drawing down the loan during the project construction period itself, any interest that is due on the loan that is rolled up and as part of the capex, and that's called IDC. This is the DSRA funding. So the 6 months DSRA funding would be made a part of the project cost because you would want to get it funded in the ratio of debt and equity, and any sponsors or lenders due diligence costs. So whatever work that you have done in securing the debt, that's due diligence costs. So guys, this case study that you see on the file, this is a case study for a project which initially was not able to secure debt, unfortunately. So this was a solar project that could not secure debt, and this is from a real example. I've just changed the numbers, but broadly they're in the same line. So this was a solar project which could not secure funding during the construction phase, and that's why once it became operational, so once it had a one operation quarter, that's when it went to debt raise. Sucho, yeah, I think your question is right. This is actually a spare, so I would request everyone to take a spare, make it spare. There's just one line for sponsors and lenders duty costs. Yeah. So as you can see, this project got funded during the operation period, and that's you would see that there's this money coming in, the drawdown of senior debt coming in actually during the operation period. So initially it was all funded through shareholder loan and share capital. So once the debt came in, the shareholder equity loan was paid off. The shareholder loan was paid off. It was refinanced. And then to a certain extent, so the net shareholder loan is 340,000. And then there was a partial equity coming as well. So there was a surplus cash of 4,000 once the project was funded. Okay. So now this is the net cash after construction. What we saw on the slide, if you remember, you saw cash flow after funding. Again, this is the type of cash flow after funding. So this is the one that we're talking about, net cash after construction. This is a small amount. Very often you would see that in real cases, because of rounding off issues and everything, typically you would have a certain bank balance or a cash flow after construction left, which is a very small amount uh, in infrastructure projects. So that's that amount. This project also has a grant coming in. So there's a $40,000 grant coming in as well. So when I say grant, it means this amount has never to be repaid back. Senior debt has to be repaid back. There's no working capital loan in this project. There's a shareholder loan, which of course, partially has a major chunk of the loan has already been repaid back, but we still need to repay 340,000, which is remaining. So that's a total of this numbers, 340,000. And then equity share capital, of course, it would not be repaid off. It would be just at the end of the period, you would just redeem all the equity. And against this equity, you would just keep paying against your retained earnings, you would keep paying dividends during the project operation period. Any questions in any of these line items? We have already pre-filled the numbers for you, but any questions here till this point? If no questions, can I say no? Can you type no? Yeah. Okay. Then let's move to the operations. Now this is where I would want you to actually start to do very basic modeling here. Now this is you have to model the revenue line for this project. Okay, and if you see in the case study, this is the revenue line. So the project commercial operation date is 1st Jan 2022. And the screen is small, but essentially we have already marked. So the project operational date is 1st Jan 2022. So that's here. We have already marked the operational fact for you. And the PPA tenor is 20 years. So that's from 2022 onwards till the end, which is till 41. So you would see that as well. Annual generation is 4 million kilowatt hour. So I have just given you the generation number, which is 4 million kilowatt hour. The PPA tariff is 10 cents per kilowatt hour. So based on this information, can you guys work on what should be the formula here for the revenue line? I'm also typing side by side. So you can either look at the screen or you just type it out yourself. If it's operating period, so 4 million to 10 cents. Again, typically we would not want to use numbers in the in any calculation, but because this is more of we don't have a proper input sheet here. It's more of a calculation that I'm doing online. So that's why I've just put the numbers here. So is this formula visible to you guys? Done. If you're done, say yes and move it. If I have 10 yeses, then I'll move it. Yeah. So Christopher, thanks. So basically, the check is that you should have 400,000 coming in from the first year of operations, right? 4 million. Again, just again for the simplicity purposes for the exercise, we have assumed that there's no degradation. Typically, you would have a degradation, so 4 million would become 3.9, 3.8, etc., etc. This remains constant. Again, it's a fixed tariff of 10 cents, so you would have 400,000 every quarter, every quarter starting Jan 2022. I just have one yes till now. Anyone else? Done. Thanks, Dia. I'll need to wait for at least 5 or 6 yeses before I. Yes, Shashank, 4 million would be same throughout the operation period. We're not assuming any degradation right now. Yeah. Just for this exercise, we're assuming it's same. 3, 4, good. Another one more yes, and then we'll move to the next line. Okay, good. So now on the operating expense, so the operating expense again, for a simplicity purposes, we have assumed that it's 2 cents per kilowatt hour. So you have 4 million being generated every quarter. So that's 2 cents per kilowatt hour. Again, just use this row so that I can copy the formula from above. So it's F6 ops 4 million into 0.02 cents. And guys, because this is an outflow, so you would have seen again that when we design cash flow waterfall, if it's an outflow, always put a minus sign below it, just before it, so that it's an outflow, it's very visible. And if it's a inflow, you need to put it has to be positive sign. So as you can see above also, all these capital spend were outflows. That's why there was a negative sign in front of them. And this is an inflow. That's why there was a positive sign. So when the repayment was, when the shareholder loans were being repaid, then we again had a negative sign because that's negative for shareholder loans, right? That's being repaid. And that's money going out of the project. And similarly, 2.4 million is coming in. That's a positive sign because that's debt coming in. So you must have 80,000 expenses every quarter. Again, if done, please say yes. We have 1, 2. Fanfan, yes, very good question. Yes, this is a quarterly model. The annual number should be 1/4. You're right. Okay. My bad. Yeah. So the 4 million number that I have given you, that's actually the quarterly number, not the annual number. So no change in the calculation. It's still 4 million per quarter. My bad. Yeah. Please proceed as on that basis. Thanks for pointing it out. Okay. So I think people are done with this. Okay. Now tax payable. The tax holiday for 20 years, there is no tax payable, right? So simply in a typical tax calculation, you would have revenue, expenses, and interest going out, and then you would actually calculate the taxation part as well. But this is a project which has tax holiday, so there's no taxes applicable in this one. So you can just ignore this line, or just for the completeness, let's just block this line. This is not in use, so there's no tax. Okay. So then your operating cash flow is 25.6 million. This is, I think everyone should have this number. Okay. And now this line, right? This cash flow CFATs, this is the cash available for debt service. Now I have a trick question for you. If you have done project finance before and you have been speaking to banks, have you faced a situation wherein the order of priority is different? Meaning, are some of the accounts, are some of the reserve accounts different in a different order? Have you seen that situation? Because one is very common in terms of MMRA. Have you faced a situation like that? Yes, no. When you're speaking to lenders. Okay, Rick, you haven't seen, have not an MMRA before. Okay. Okay. So in some of the projects that you would observe, like there's a possibility that lenders would say that MMRA is a mandatory requirement. So CFATs should include the provision for MMRA as well, meaning because MMRA goes to the heart of project operations, meaning if you don't do MMRA for certain projects, the projects may fail. So this classifies as a very key construction or operating expense. That's why sometimes this MMRA is ranked over and above this debt service. So in the waterfall mechanism that we are showing you, MMRA is ranked lower compared to DESRA and debt service, but very often this account may have to be moved over and above CFATS line. So just take care of that. By default, by the industry practice, the default practice is that CFATS, the debt service is ranked higher both with all the reserve accounts. So debt service is always higher than DESRA or MRA. But in some cases, you may have MMRA being ranked higher as debt service. So this may affect your covenants like DSCR, etc., because your cash flow available for debt service would reduce. So, for example, here we have seen that the MMRA provision is 15,000. So your CFATs 22,000 would reduce by 15,400, and that's the new number. Now, because CFATs is reduced, your DSCR would also come down because DSCR formula is CFATs divided by debt service, right? So because CFATs reduced, that debt service will also reduce. So, Rick, your question is LLCR. Okay. What are you asking? What happens to LLCR? Is that the question? Okay, as a check. Okay. Yeah, so yes, both there are few covenants that you would come across. Let me just list it down in the file so that you're aware. So you have DSCR, you have LLCR, and you have WAL. Has anyone heard of? I'm sure everyone knows what DSCR is, right? Can anyone just type in the full form on the chat box? What is DSCR? Okay, yeah, that's debt service coverage ratio. Okay. Good. Now, what is LLCR? Are people aware what's LLCR? And or maybe, yeah, loan life coverage ratio. Okay, so Rick, do you want to give the formula? Because I think you have been using this, right? So what is the formula for LLCR? How would it be computed? And if anyone knows what WAL is, very happy to hear that as well. Because this is the term that you may face when you're working with European or American banks. WAL. Has anyone heard of that? It's more common when you work with people like mostly American banks. Just have heard of it. Some European banks also use it. I see some responses coming in. Okay. So if you have not, but yes, so okay, so WAL really stands for weighted average life. You can do a Google and you would find the formula itself. But essentially, this tells you what is the average life of the loan. So even though the door-to-door tenor is around 15 years for any loan, but once you calculate the WAL, weighted average life, it might come down to 8 years or 7 years. So faster the faster the repayments, the lower is the weighted average life. And I think if time permits, once we can come to the debt repayment profiles, I will also take you through some of these calculations for DSCR, LLCR, and weighted average loan. So, but yeah, these are the these are the 3 or 4. These are the 3 main common ratios that you would come across when you're doing project finance transactions. Okay. When we are on the next session on debt repayment profiles, then let's try to see the time left and we will go through these calculations as well. Okay, so just to Rick, just to close the loop on your question. Yes, so LLCR is essentially not a reserve account. That's just a covenant check for lenders, whereas DSRA and MMRA are reserve accounts. Okay, so moving on. Okay, let's come to DESRA. So the problem statement says that DSRA is created as part of the CapEx and is released in the last repayment period. Interest income on DSRA is 2% per annum. So can anyone tell me from the Excel file, what is the amount for DSRA here? What is the DSRA here? Based on the diagram that you have, based on the Excel you have, what is the DSRA amount here? Very simple, it's very easy. Okay, good. So now the statement says that DSRA would be released in the last year of operations. Sorry, last year of repayment, last repayment period. Okay. So can anyone come up with a formula when to release DSRA, because that's an inflow to the project, right? How would you release DSRA? I'm just choosing one formula which I think is useful here, but then so using principal payment is less than 1, then release DSRA. Yeah, but then yes, you have to just ensure that you don't release this. It has to be released only once, right? Because there are multiple periods and there are multiple quarters here which has principal payment less than 1. So you have to just release it once, not multiple times. So I have used this formula. I think I've done it correctly because it saves only 500,000. So I've just released it once. So this is one formula that you can potentially use. But then I'm happy. Your thoughts on this. Yeah. Let me just magnify. So the last repayment period for this project, as you can see from the principal repayment profile, last repayment period is happening in April 39 to June 29 quarter. So that's when you should be able to release DSRA. You can try your own formula, that's fine, but essentially the concept should be more clear. So if you're able to get this 500,000 correctly in this column, then that's fine. Once done, please say yes. We'll then go ahead. Because what I'm trying to do within the formula, what essentially it does is it will check for each quarter, it will check that the current principal, in the current quarter, there is a principal repayment, and in the next quarter, it's 0. But basically, if this situation arises, it means that I am at the last principal payment, right? Because we are working on a quarterly basis. So once it's true, then you just release the entire DSRA amount, which is 500,000. That's how. Thanks, Chris. Thanks, dear, for confirming. If Rick, okay. Anyone else who has done it? Okay, good. Okay, now interest on DSRA. So the problem statement says that the interest income DSRA is fixed at 2% per annum. So again, this is 2% per annum. So on a quarterly basis, that's 0.5%. Just FYI. Okay. So let's do that formula as well. Can someone go it ago? So this is a positive inflow that should come in because DSRA has been created at this point in time, right? So starting this quarter, starting the July-September 22 quarter, you should be able to earn income on it. So starting this quarter, till the time it is released. So you should have numbers in these cells till CR, till the time it is released. So please just have a try. How would you go about it? The reason I'm asking you to try the formulas as well, because typically in a very good financial model, general practice says that you should have the same formula throughout the row, right? So that's why I'm encouraging you to find the solution such that you can use the same formula throughout the cell. By this, if ops, so it should be creative period, sum of. So I can either do a sum of. Okay, and also I just want to kind of clarify that in a typical, when you prepare a full model, right, you will not you not have to put a complex formulas here because you would have a separate sheet to calculate all these numbers. It's just that because we are doing in the same sheet, that's why the formulas might become a little complicated. Again, you might do in a different way. There's no one way to do this. So please, if you have some other way to do it, and if someone can suggest a better formula, very happy to look at it. Why not? Just type in the chat box if you have a better formula. Very happy to look at it as well. If I remember correctly. So, what is this? So we are starting from this period. That's the period in which started 2500 per annum. And we should end at. So typically, if something goes wrong, you can actually look at the formula and see what's happening there. So why this is still 2500. So what's true? Why this is true? This is ops. Sum of this minus. Okay. Should be plus. Yeah. So yeah, so we have till 500,000. So I'll give you my solution, but if someone has, so if you have a better formula that you have already used, please do type in the chat box as well, because this has become a little complicated. Yeah, you should have 170,000 numbers. So as long as you have 170,000 as your figure, starting from July 22 quarter till the last quarter of Tesla release, you're good to go. It's so because we had the formula that I have used essentially is that, and let me explain the formula as well. So first of all, I'm checking that we are in the operation period. So that's if and J6 is equal to ops. And then again, checking that the sum of the DESRA, basically, this is the DESRA inflow. This is when the DESRA is created. And this is the DESRA release amount. So if the sum of these two items in the previous quarter is different from 0, then we would calculate the interest. If it's 0, then we will not calculate the interest. So see in this form, in this quarter, what's happening essentially is if I go to the last quarter, this is true because you had at ops, but then the sum is equal to 0 because I have already released DESRA as well, 500,000 by this quarter. So that's why this becomes 0, and that's why there is nothing being computed. if I can understand if people have done this, yes, please on the chat box. I would encourage you to try, try the formula instead of, because I know you can use a shortcut of just using 2500 as a hard coded number, like with, but then if you can, or maybe after the class, try to get a right formula for this because it helps you to program your mind accordingly. Okay, thanks, Rick. I'll wait for one more minute. Yeah. Okay. Don't worry, you will have the solution for the book, so you can see some alternate formula there. But then yes, I hope you understand the concept. If can I ask the class if the concept is clear for Destra income? That also helps. So if that's done, maybe just type yes, that you understand what is the concept here, like how the Destra income should be computed. Yes, no. Okay, good. Okay, let's go ahead. So now we have done the Destra, and now we come to MMRA. So there's MMRA already being filled. The MMRA account has already been filled for you. Any questions at this point in time? Like, are you clear with the waterfall till now? Yeah. Okay. Uh, then so now we can see, right? Let's now see what's happening here. So we have, so for the purposes of this class, I've already created an MMRA for you. So you can see that we are collating 15,400 every quarter for the MMRA, right? And this is the period that the actual MMRA takes place, right? You can also include different lines which says, let's do that. Let's do that now. So let's say major maintenance expense. And guys, please insert these two lines so that it's very clear. Cash release from MMRA. So again, we are not doing it via. So will Destra funding be part of the total project cost? Yes, Shashank, that's correct. So if we are creating a 6 months Destra, if it's decided, yes, the Destra funding would be made a part of the project cost. As you can see here, it is a part of the project cost itself. Yeah. And this would be funded in debt equity. So that the sizing would take place accordingly. Okay. So here, guys, if you can go to this column of row 28, so you can see that there's an MRA being done. And again, what I've done is I have actually made this manual adjustment here, but I would recommend that because you would have an MMRA account being created uh, in the financial model, the large financial model that you would, this is just a part of that cash flow waterfall. You would see that these MMRA provisions are also coming in. So we have 3 MMRA cycles here. Because this is hardcore input, I've just put it yellow. So I would recommend that you can insert these lines when you prepare cash flow waterfall because it shows that you need a major maintenance of 308,000 in year 28, starting April 28, and you have accumulated this much cash in MMRA account, which can be released from the account. So this will show, although the impact on the cash flow waterfall is nil, there's no impact on the waterfall because it's plus minus, but then it helps you to visualize that how much is the amount for major maintenance that you have to spend. No impact on waterfall, but this is more from a visualization perspective. It's always good to see how much you need and at which interval, in how many years you need that amount. Yeah. And then this is the interest income on MMRA. So this is based on you would create an MMRA account in your project finance model, which would have an opening balance, addition, and closing. So you would calculate an interest on that. So this is the interest amount being computed. Again, hard coded for you right now, but this would be a part of your project finance model. And now we come to cash flow for subordinated loan. Okay. There is no subordinate loan on this project, so it's all nil. So the same cash flow is carried to the distribution part. Okay. Let's now take a pause here because before we move on to distribution, I want you to understand what has been happening till now. So assume you are in period number 3rd quarter of the operation. So let's see this. So in the 3rd quarter, you had 320,000 of cash available after operations, assuming there are no taxes. And this is the cash flow available for debt service, CFADs. You serviced your debt of 39,333,000. You serviced your debt, which is total 72,000. And you can see the formula here is then after servicing your debt, you have cash flow available for DESRA. Then you did you had a DESRA income, which was added to this cash flow for DESRA. There was no outflow. There was only inflow coming in because you had already created an account and you were earning income on it. So you added these two figures and then the cash flow for MMRA was 250,000. In this quarter, there was no provision from MMRA, so it's all nil. So you have cash flow available for subordinate loan as the same figure, 250,000. Then no working capital loan, so this remains same. For available, you have 250,000. Okay. Now, here comes the shareholder loan. Now, if you see, there's a formula that is already put in for you, and I hope you're able to see this. But we have assumed that as soon as the opening cash balance of the previous period. Okay, so this is the opening cash balance of this period or ending cash balance of the previous period. So as soon as you have accumulated 620,000 in the previous period, which is more than the net amount of shareholder loan. So the net amount of shareholder loan was, you saw it's 340,000 because a part of that has already been paid off, but you still had 340,000 remaining. So this model right now assumes that as soon as you have 340,000, if you have the opening cash balance or the previous year ending cash balance more than 340,000, this gets paid off fully. Now, this is particularly for this assumption. It's a bullet repayment that we have assumed. Sometimes in many projects, lenders would put a condition that you can repay shareholder loans only after the debt payment the debt has been fully repaid off. So now, can you try changing that? Can you try changing this formula to a scenario that this 340,000 is paid only when the debt is fully paid off, which is in quarter number in July 39 quarter. Have it a go, like try it out that you would pay shareholder loan only if the debt has been fully repaid off. How would you go about it? because you have 18 million cash available, so you can easily repay this amount. And while you are trying that, can I ask the room that can I ask the class, have you faced the situation? Because lenders typically would have put this condition that on any unsecured loans that the shareholders would have put in, they can be repaid only after the senior debt is paid off. Have you seen that condition in your term sheets? And have you come across this? Okay, thanks, Pradeep. Okay, thanks. Thanks, Chakuta. Okay, good. Okay, Rick says always, yeah. So yeah, in some jurisdictions, it's always a condition that shareholder loans can always be paid off. But yes, it's by default, it's not true. Sometimes lenders do allow shareholder loans to be also be paid off. So it's not a by default, but then yeah. Okay, so let's try this out. Let's ensure that the shareholder loans are only repaid off once the debt is paid off. Huh? So let's do that. Happening here is that that's not 46, that's row number. I'm adding should be debt principal, that is 46. If sum of 46 is 2.4 million. Can everyone ask? Can I ask everyone to use 0.4 million here? Because I think this should be 2.4 million. Just make it 2.4 million, the loan amount, please. Just make it 2.4 million instead of the another figure that had, because the repayment that as per the repayment curve that we have, we are repaying an amount. As you can see, the debt service repayment is only 2.4 million. So we have to keep it 2.4. Just change the drawdown amount. That's fine. Even if there's a shortfall, that's okay. Let's see now whether we are on right track or not. So the repayment has happened. Sum of this. This is equal to 0. So system false. Maybe there's a rounding of it. Let's just try it. So it's a little complicated formula, but I've used an array mechanism to do this. If someone has a better idea, please. So what I'm checking for it, I'm checking for two things here. So let me explain the formula as well. What I'm trying to do is that I am checking that this round formula says that the sum of all the repayments till this quarter, so till the previous quarter, sum of all the repayments that's happening in row number 46, if it becomes equal to the total principal amount, then you can repay off the shareholder loan. So that's the formula here that you see. Just zoom it out as well. So if the sum of all the principal repayments. Okay, so we have an alternate formula. If and JC is equal to ops, J88 is greater than 0.2. Okay, so that's fine. J88 is the ending cash balance. And sum of I77 is equal to 0. Sum of J40. Yeah, so essentially, yeah. So I think you have checked the same thing. So Christopher, yeah. So I think you have put one more check that it should be during operation period, and then the opening cash balance should be greater than the shareholder loan. Yeah. Okay. That's fine. But yeah, so essentially what you're checking is that there has been no repayment here. So when I say sum of I to I, so if you see here, essentially I'm checking that there's no previous repayments, and that's why I'm doing a bullet repayment here. So Chris has also given a solution. If anyone has some alternate solution, please feel free to enter. So we'll wait for 5 yeses before we move on. So you should have minus 340,000 as your number, and you should be coming in quarter number starting 39, April 39. If you have this, then you're done. Yes, no. If any questions on the formula, please feel free to ask on the chat box. Happy to help. So if any doubts in the formula or in the mechanism itself. Okay, thanks, Rick. Can I also ask? I think there were a couple of people, Lynn and Pradeep, who had not received the attachments. Guys, have you received it now? Pradeep, and there was one person, Lynn. Okay, thanks, Pradeep. Okay, thanks, Lynn. Thanks. Right. Okay. So let's go ahead and let's go to cash flow available for equity. I'll zoom out my screen again so that now we can see the cash flow movement on an overall basis. So let's go to some quarter in which we have a repayment. Okay, let's go to column number BO. Yeah, I'm on column number BO. So here, as you can see, you had 320,000. The debt service was 48,000. You had 271 surplus. Then you had an income of DESRA as well, 2,500. You did the major maintenance, so all that's fine. But you released it and then you fund because it was already funded, so no impact on the cash flow. So you will see 274,006 and 274,066 here. There's available for distribution. That's the amount. And then that's the cash flow available for equity, 270,4066. Yeah. Now let's try to do dividends as well. Do we have a problem statement here? Okay. So okay, I'm giving you a problem statement here for dividends. So if you can map it out. So the statement is that dividends are paid in every Q4 to the tune of, we have surplus cash. We have a lot of cash available in the company. So let's extract maybe 750,000 in each payment. Yeah. So this is the problem statement. So if you can try to do this, so typically you would have dividends to the extent of profit. So that's how you would usually model it. But for the purposes of this exercise, please ensure that in every Q4, in every fourth quarter of the operation period, you have 750 dividend payment coming in. You have 750 going to the shareholders, to the shareholders of the company. Or maybe 750,000 might be too aggressive. Let's just make it 500,000. So let's try to model that. So it is if you have all the period of the year. Flag. Then you have minus 500,000. So can I ask the room, should it be minus 500,000 or plus 500,000 in the formula? You can just say plus or minus. Minus, okay. Yes. Okay. So I hope you understand the concept, right? Because this is the amount which is going out of the project. That's why it's a minus sign. Yeah, okay, good. So let's say that it's a pretty simple thing. So I hope you have this. So we have ensured that during the operation period, you have 500,000 going out as dividends. Let me copy the formula for you as well. Done. Chakradhar, you don't have the file. I thought it has been sent to everyone. Can you share your email ID, please? Then I'll do that. Please send an email to info@yoginfra.com and you will receive the Excel file. Shashank, yes, the dividends are at tune of 500,000. So we changed that amount to actually to avoid an undue cash burden on the project. So let's assume 500,000, please. Yeah. Okay. So is everyone done? So as a check, can I confirm that everyone has a net cash flow in the period of 11,154,684? Yes, so Shashank, yes, so that's why we have reduced the amount of the dividends of 500,000 because the project, we didn't want to ensure that the project has a negative cash flow. So we will also insert a check now that we don't reach negative cash in any period, although it doesn't seem so. But yes, whenever you pay out dividends, there are a few checks that you need to follow. So I'll just list down these checks. So dividend payout checks. So number one being that dividend should be maximum, should be equal to maximum 100% of PAT. So that's check number one. So for example, if your PAT is $100, you can only pay out $100 of dividend. That's a maximum. Sometimes sponsors have a rule that they can only pay 50% of the dividends or 20% of the dividends. So that's internal rules. But yeah, maximum you can pay 100%. And that's usually an input in your input sheet. The second check pick that dividends can be up to maximum of sum of dividends are limited to an amount equal to sum of two items. One is your opening cash for that period plus and cash available equity or cash available for distributions after SHL repayment. So this is a limiting factor here. So in a scenario wherein you have, let me just see if we can find a scenario here. It's an Excel file. Okay. Okay. So let's see this scenario in column number U. Assume that the profit for the company was 500,000. That's why we have put 500,000. Now the other check is that the amount that you have to pay can be maximum of 247, which is the cash flow available for equity distributions after repayment of shareholder loan, and your opening cash balance of 800,000. So 1.05 is the maximum you can pay, because if you pay more than 105, any guesses what would happen? If you pay out 1.1 million of dividends, what would happen? You assume your profit is $2 million. And if you pay out 1.1 million of dividends, what would happen here? Any guess? Like, try just very simple. Any answers in the chat box? You can try doing that very quickly. Correct. Yes. So good. So yes, the answers are correct. So if you do 1.1 million here, you would have a negative cash flow, which is an error. So your a very, very basic thing is that the cash flow cannot be negative in a company, right? So that has to be ensured. So always there should be positive cash flow. Okay, so Chandrakar, you can't take a loan to distribute dividends. That's not allowed. You can't do that. So no, it's just that you have to, when you're doing the dividend calculations in your model, you have to limit it to this amount. Also, let me add one more covenant here. So it's opening equal to opening of sum of this less minimum cash to be maintained. So in some projects, you have a minimum cash balance to be maintained, that there's a requirement that a minimum 100,000 has to be maintained in a company, right? So in that case, it's even lower. So you have to reduce that amount when you do the formula. So that's the second point. So dividends should be less than reserves and surplus. Correct. Yeah, of course. So as I said, it should be equal to max 100% of PAT. Yeah. So typically you would not look at cumulative reserves. You would look at reserves during that period or PAT during that period. But past reserves and everything, it's not very typical in project finance transactions that if you're not distributed dividends in the previous period, now you're distributing it because I have the retained earnings, right? That's usually not allowed during the project as long as the project debt is active. So the dividends are limited by maximum of P&L, the profit PAT during that period or during that quarter, during that year. Okay, so guys, so I think this completes your cash flow waterfall. If any questions here, can I confirm everyone has this 11,154,684 as a closing balance, please? So Ravi, should we keep aside the reserves created for major maintenance? Yeah, of course. So we went to this. So this MMRA account that is being created, that's the reserves that we're keeping it aside for the major maintenance. So that's already hard coded for you. So that's the reserves that are being created for the account. Yeah. So, okay, so Rick says yes, 11,154,684. Can I get 4 more people saying yes, please? 11,154,684 if you have this number. Okay, thanks, Chris. I see some people are not responding that much. I hope you're following, like Kent, Santi. I hope everything is okay, right? Joner, any capping for DESRA reserve? Yeah. So Pradeep, the DESRA reserve is usually defined using. Thanks, Joner. Yeah. So DESRA reserve is usually defined as part of your term sheet, and we will go about that term sheet key clauses as well. So the capping is in typical infrastructure projects that's equivalent to 6 months of interest and 1 principal payment. That's how the DESRA is defined. Okay. So I think we have few people who have done already 111,154,684. So let's go ahead to the next section of the masterclass, which is more about debt repayment profiles. So for insurance purposes, which area should be focused to insure? So Suchu, can you expand? What kind of insurance are you talking about? This is for delay in startup insurance. Okay. So as Suchu, let me put your question in another way. So your question, do you mean that as lender, which area you should be focusing on for delay in startup, taking up delay in startup insurance? Are you asking from a lender's side? Correct. Switch. Okay, guys, let me do one thing. Let me just finish the next section as well, and then we will do, let's go to the treatment profiles. We will then go take some of these questions in the Q&A session, yeah, because we have quite a bit done. Take over. Okay. So now let's go to the deck again. Okay. Yeah. So yeah, I have 3 or 4 questions on the chat from Sijo, Rick, and Kent. Guys, your questions are noted. Let's just go to the session, and then we have time for Q&A. Then we can go because this is not really cash flow waterfall, but I'll try to answer these as well. Yeah. So now then debt repayment profiles. A very quick question to the class. How many debt repayment profiles are you aware of? Can you just type it out? What kind of repayment profiles have you seen typically in project finance transactions? Just very simple question. Amortization, okay, good. Anything else? Anything different? Balloon repayment, okay. Then bullet, good. Sculpted, okay. We are going to talk about sculpted in a little more detail in this session. Yeah. And there's one more, which is really very common. So besides amortization or EMI principal, bullet, ballooning, there's one more. You can see. And guys, a hint, it is already there in the Excel file, the other sheet. Okay, so the third one is equal principal. So essentially the same amount of principal being paid off throughout the project. Yeah. Okay, so let's very quickly go through the most simpler ones. So equal principal payment plan provides for payment of accrued interest on an unpaid balance, plus an equal amount of principal. And as the principal balance is declining, of course, the amount of interest accrued also declines. So you can see here, this is a very simple example for $10,000 loans. Again, this is an image from the internet, wherein you have an annual payment going on of 2450, out of which principal is fixed at 1250. So you have 1250 throughout the 8 years, and the interest is calculated on the remaining principal and on the unpaid balance, and that's how the principal moves. So total 10,000 is being paid off equally over 8 years. So equal principal, very simple, nothing rocket science. Yeah. Then mortgage, amortization, EMI, there are different names for this, but that's what it is simply. What simply it means is that the total payment amount, right? The total payment amount, including both interest and principal, is the same throughout the period. So you can see that in this figure, it's 2013 in every period. Principal and interest are varying, right? But the overall total amount is, this is usually, if you have taken a personal or a car loan, you would have this EMI payment as well. Sometimes, typically in project finance transaction, this is a very less increments. There's not a lot of, sorry, the equal principal is quite less. Mortgage is the second most common one. Yeah, so mortgage is second most common for project finance transactions. The most common repayment profile that you would see is sculpting. Okay. Just a show of hands, maybe, or maybe you can just type on the chat box. If everyone understand what sculpted is. Or if you don't understand, maybe just type no if you don't understand what sculpting means. I think that would be better. If there are people who don't understand what sculpting means. Okay. 1, 2. Okay, so let me explain that in a little more detail. Yeah. So sculpting means that the principal repayments that you're doing have been calculated to ensure that the principal and interest obligations are appropriately matched to the strength of your cash flows. Okay. And sculpted principal repayments are very common in those projects where the market risk is with the developer or with the off-taker. Can you choose the right option? So where do you see sculpted payments? Where the market risk is with the developer or the market risk is with the off-taker? I'm taking an example of a toll road project in which there's a traffic risk on the developer. Do you see sculpted payments or no? Okay, so we have different views. Yeah. Anyone else? Just a wild guess, like where would you see sculpted payments? Wherein the market risk is with the developer or with the off-taker? Or irrespective of that, you always see sculpted payments. Okay, there are a few responses. Yeah. So the right answer is yes. Sculpted is very common, really very common in projects where the market risk rises with the developer. And that's because imagine you're on a BOT project or on a toll road project, right? Or an airport project, port project, wherein your revenue is not fixed. It's not an availability based payment. The revenue is varying for different periods because you are bearing the traffic risk or the demand risk. Your road, the toll road that you may have constructed, there may be 100 cars flying on it on one quarter. Next quarter, there may be only 50 cars. In the third quarter, there might be 1,000 cars because there's a new city development that has come up. So the road is being used by 1,000 cars. So as you can see, there's a varying cash flow. So whenever there's a varying cash flow, right, in the periods where you have a lot of cash, a lot of revenue, you can pay debt more because you have that capability. And in the periods you have less revenue, you can't pay the debt in the same quantum. You have to reduce the debt payment. So the sculpting means that you're actually sculpting. The word sculpt, if you are a sculptor, who gives shapes to rocks, right? And makes very beautiful uh, objects out of it, right? So then you're sculpting your debt repayment in accordance with your project cash flows. Because in a project finance transaction, cash flows are the only thing that would drive your debt repayment. There is no sponsor guarantee typically, or even if there's a sponsor guarantee, it may fall off after 2 years or 3 years. So that's why you have to sculpt your debt based on the cash, on the cash or the revenue that is expected in that year. And this sculpting is done at the beginning of the debt repayment itself. That when you are signing the loan documents, you can't keep sculpting throughout the period, right? Because so it is done at the beginning of the project, at the beginning of at the time of financing documents, but with a reasonable estimate of your demand. That okay, I do expect that there's a seasonality in my traffic pattern because that's why those traffic studies are done. Similarly, if you're operating a solar plant where the entire power is being sold to the market, there are seasonality considerations to be done because my plant would generate 20% of my generation in Jan to March quarter and maybe 34% in the later quarters in May to June quarter because there's more sunlight. So the sculpting is done based on seasonality factors, based on traffic estimates, which have to be agreed between lender as well as the developer. So this sculpting ensures that the DSCRs that are coming out of the project, they are less volatile compared to the normal case. And as I said, sculpting is required in following situations. These are irregular cash flows, but they are well understood cash flows, meaning then that you understand how the seasonality works, how these estimates work. So they're well understood. These numbers are well understood. There are seasonal demand factors. As I said, that's very common in power, agriculture, manufacturing industries. There's a ramp up period for a new project. So for example, in a toll road, you might see that in the initial 2 or 3 years, it's only 100 cars or 500 cars. But once the road is very well recognized, people have started using it. It's actually a shortcut. There's a demand. That okay, right now there are 500 cars for the first 2 years, and then we expect it to grow to 800 cars, and then 1,000 cars, and then 2,000 cars. So that's how we expect the demand to grow. So there's a ramping up period. So even your debt repayment initially would be small, and then the percentage quantum would increase over time. Essentially, what we're in all these things, what we're trying to do is that you are trying to match your principal repayments with your cash flows, with your revenue cash flows, right? And that the sculpting happens again, a multiple choice question for the class. Do you sculpt principal or do you sculpt both interest and principal? A very, very common question, because you need to understand what are you sculpting exactly. Okay, guys, I think people are saying both, but unfortunately, I'll have to disagree. The sculpting is essentially for principal repayments. It's not for, because interest, you can't sculpt interest. Interest is simply based on the outstanding loan amount that is there in the project. Okay, so you won't sculpt interest, you would only sculpt a principal repayment. So even in the periods you have a lower principal repayment, you still have to pay interest on the loan amount. So then it comes to the question of debt sizing, that should you reduce debt amount so that your interest is low. So that's a question about debt sizing. But from a sculpting perspective, if a debt has been decided, if it's $500 of debt that you're taking in, then you would only sculpt how that $500 of principal amount would be repaid over the years. You won't sculpt the principal repayment. So please keep that in mind as well. Now, have you seen there are two kinds of debt sculpting? One is flexible tenor and one is fixed tenor sculpting. Can anyone explain what is a flexible tenor sculpting? Are you aware of this? Or maybe if you can see that, okay, if I tell you that my loan tenor is 15 years for a 20-year project, my loan tenor is 15 years. If I want to sculpt debt, in the project finance transactions that you have been doing or you have been a part of, are you allowed to reduce that 15 years to 10 years or it remains 15 years? The actual sculpted repayment profile. Okay, so Chris, I assume you're saying that you are allowed to reduce from 15 to lower years, right? So I have. Okay, so anyone else who has come in a situation that the tenor can be reduced? Okay, so Rick says you have not seen a term reduction. Okay. Anyone else in your experience? When you sculpt the debt, does the tenor reduce or it remains the same? Because that's the two differences, right? When I say flexible tenor, it means that you are allowed to repay the loan early. The full prepayment can happen earlier than the tenor date. So if it's a loan of 15 years, if you want, you can finish the loan off for 12 years because you have more revenues. So that's flexible tenor. So through sculpting, you're allowed to sculpt the loan such that it has a flexible tenor. And in that case, the only thing, the sizing formula or the sculpting formula is this. It's principal equal to cash available for debt service divided by DSCR minus the interest payment. Okay, so that's one way of sculpting. The other way of sculpting is fixed tenor, meaning that the lender has given you that's a 15-year loan. You can't change the term loan. It's 15 years, but you are allowed to sculpt the debt, meaning you can vary how that debt principal is repaid off during that same tenor. Now, there are different uses for this, right? So if you have a flexible tenor, it means that you're repaying off your debt early, right? It means that a larger amount of cash is going towards repayment of debt, which means that you have a lower interest payment. But because a larger amount has been used to repay the debt, you would have less amount for distributions or for dividend payments, right? So for projects wherein the lenders say that we will not allow you to take out dividends during the term of the loan, you might as well go for flexible tenor because there's no use of keeping cash in the company, right? It's better if you prepay the loan and then you can take out dividends later as when the loan is repaid off. So that's when the flexible tenor is being preferred. But in cases wherein lenders allow the sponsors to take out dividends during the term tenor, during the loan tenor, you would actually prefer a fixed tenor payment because you would not want to pay off your loan early. You don't want to put all your cash flows towards loan. You would pay what is needed to satisfy your covenants, and the remaining you would want to withdraw as dividends. So that's why fixed tenors are more preferable if dividend payments or shareholder loans are allowed by lenders during the loan tenor. So just, when you read your term sheet, just take care what kind of project you're looking at, and then you can choose which sculpting method to follow. A very common sculpting method that you would have seen in the project finance transactions is typically flexible tenor, especially in Asia, because you are not allowed to take out dividends during loan tenors. But then if you go to geographies like Africa or even in certain Middle East geographies as well, in European and American projects, you would see that fixed tenors are being preferred by sponsors, and lenders are also okay with it because you are allowed to extract dividends during the project tenor itself. For example, right now, as YOG Infra, we are helping a client to raise debt for a project in Africa, and the financier, the lender is DFC, US Development Finance Corporation, DFC. So they have allowed dividends to be paid out during the loan tenor. That's why we are going with a fixed tenor curve rather than a flexible tenor. Is it? I hope the concept is clear, and I think today we are going to actually learn the fixed tenor sculpting, because I'm sure flexible tenor is very common, so you must have heard it. But let me try to do both if the time permits. But let's first do the fixed tenor payment. Yeah. Okay. So can I ask you again to open the Excel file that you have and go to the debt profile sheet, please? Yeah. Okay. So you can ignore the one. Let's very quickly make this loan account. Yeah. So the opening balance is equal to the closing balance. That's fine. I hope my screen is visible, right? You're able to see the screen. Can I someone say yes, please? The Excel is visible. Okay. Yeah. So I would suggest you can link this row number 23 to row number 54, please, as of now, because that's where we will calculate the various kinds of profiles. So you can just link it to this and put a minus sign below it, please, so that it's a repayment. Don't worry if it's 0. We will make the repayment profiles very shortly. Yeah. So this is the sum of everything. So that's fine. Yeah. Okay, let's go to the periodic interest rates have already been filled for you. So the interest accrued is simply this percentage. And for simplicity right now, let's just use the closing balance for the opening balance for the calculation of interest, please. Just use the opening balance. There are again different ways you can do average of opening closing, but that's fine. We're just using the opening balance right now. Again, don't worry about the numbers right now. We are just making the structure once the principal repayments come in. And upfront fee is equal to, because there's a single drawdown, you can just link it to this line. You can link it to the drawdown, or maybe not drawdown, just link it to the total loan amount and your first drawdown flag. Yeah. Just freeze these cells, please. You can get 4. I'll just copy the formula for you. Just very quickly. So this formula is 4. This is all. This closing balance is simply linked to the line below. Yeah. Principal is the interest rate is already filled for you, so just here. And the interest payment, the upfront fees. Yeah. Okay. So let's go to your principal repayment file. So let's start. Now this is right now. Let's start with a fixed tenor sculpting. Okay. Can people say yes if they are done with till row number 29? Or maybe just Y. That's faster. Just say Y if you're done. Any 4 people? Y. the letter Y if you're done with this, please. Okay, good. Right, so let's go to this principle. Okay, now we have created a base profile for you. Now this base profile, let me tell you how it was computed. This was computed as a percentage of revenue, the revenue percentage during that period. So for example, if the total revenue for the project was $100, in this period it was $1.18, and similarly it was $1.3 here. So this formula is essentially 1.3 divided by 100, the total revenue amount. So that's why this percentage payment, this is the base repayment profile. Now this base repayment profile is active only till the repayment is active. See, the repayment is active only till CI. That's a repayment period, right? So till that time, your repayment profile is active. Sorry, till 39. So guys, can you just help me drag this for 2 columns? It should be Y39 because that's December 39. So your repayment profile should be active maximum till 39. So here we have done it. Okay, we have done it for a shorter period. So let me just go back to what it was. Let's assume that the bullet repayment is happening here. So guys, just in your Excel files that you're working on, just ensure that both the flags for repayment and bullet repayment are in 30th June 39 column. So yeah, so we have calculated this base repayment profile. Now the actual project might have revenue even after this, right? But then since there is no repayment allowed after this period, that's why it was curtailed during this period. So this is, if you add up these entire number, that's 85.21%. Okay, it means that if you strictly follow the revenue numbers that are coming in during the different repayment periods, you would be able to pay only 85.21% of the loan. You won't be able to pay 100% of loan. So now what you have to do is you have to revise these percentages such that the total is 100. And there is a multiplying factor. You can calculate this multiplying factor in your sheets using a goal seek mechanism, which has already been done for you right now. But essentially you have to goal seek this number such that if you multiply these numbers and you add them up, it turns to 100%. So simply this number that you see here, this number is essentially 1 divided by 85.1. Sorry, this number is so this into 1 plus goal seek should be 100%. So it's 1735. Okay, number that we have is not correct. Yeah. So if you see this markup number that you see here, this is a constant number that you see, which is 0.1735. So the check is that if you choose any number, this is a constant number throughout all the quarters. So if you choose any number, multiply 85%, which is the sum of this. So 85% into 1 plus this number, this macro number or goal seek number, it should be 100%. So the idea is that you are now trying to make this loan repayment profile, which was sufficient only for 85% of the loan, you're now making it 100%. And now just using this, what you actually have done is the tenor remains the same, right? So you have the tenor as still what was envisaged under this project. So tenor has not changed, but you have matched your repayment profiles. You have varied it over the period and have matched it based on your revenue flexibility. So for example, in periods where you have high revenue, you have a higher repayment. And in periods where you have low revenue, there's a lower repayment. So this might seem a very constant seasonality for you. So 1.38, 1.5 to 1.57, 1.6. And again, this is a very, because this is a solar project. So in solar projects, as I earlier mentioned, right, for every quarter, your seasonality or your sunlight might differ. That's why you have a seasonality factor there. So you see these numbers being repeated. So it's a seasonality factor that is at play here. And simply your principal payment should be equal to this, the percentage profile, into the total loan amount, which is 2.4 million. Just guys freeze this number so that just freeze that formula so that it doesn't change when you cross rows. So these are the formulae. Just copy it for you. So the final check is that you should have a 2.4 million repayment happening. Anyone who has done this or any questions, please type it out. I'll try to answer. Yeah, if this is clear. So essentially, you had this revenue profile. Essentially, what you did, you found out a multiplying factor such that you can make it 100%, the entire repayment, and then you just calculated, multiply with the loan. What is the repayment number? Now, this what you have just done is a fixed tenor sculpting. Clear? If it's clear, maybe can you type C here? C on the chat box. It's clear. Or if it's not clear, please feel free to ask a question. Okay, thanks, Rick. Okay, good. So now what you've done is a fixed tenor sculpting. Okay. Now let's do an EMI payment. Can anyone help me with the formula how you calculate EMI? Are you aware of these functions, PMT and PPMT? Are people aware of this? There's a PPMT function. PPMT. You ever heard of this formula? Okay, I would want people to have a go at it. So just try out this PPMT function as well. I'm conscious that we have only 10 minutes in our class, so but it's just so I can give you a hint, just try to complete this section using a PPMT function. And again, the check is that you should have the total repayment equal to 2.4 million here. Yeah, this is the number that you should have. And then that's equal principal, right? So it's again very simple. If you have a repayment happening, so that's if structure. So if the repayment flag is active, it's equal to 1. The repayment would be that 1 divided by the total number of repayment quarters, right? Else it's 0. So simply you can just drag it across. Just to see that it's 1.47 every quarter and 1.47 into 2.4 million the total repayment profile. The repayment amount. So that's 35,924 every quarter. So that's the amount that you should have in your. Yeah. So you should have two prepayment profiles already done. One is sculpted, one is equal principal. So we have chosen sculpted out of it. So you see that formula here. So we have chosen sculpted out of it. And now this is the profile that you'll be working with. Now let's see in a cash flow waterfall, we can link this principal profile also. So you can actually try to link this to your repayment profile. Just put a minus sign there, guys, because it is an outflow. And you have this. Just 1 second. Sorry, my bad. Should be J. Yep. Okay. So now your interest, as like typically we would insert a summary of this. Let me just copy this formula for you first. So this is this formula. This is again very simple. And this is already filled in for you. Now interest you would link to your interest payment. So that's here. Interest to be paid and your principal repayment to the chosen profile. So then you have your principal interest repayments. And now because you would automatically see that this has been filled up, your repayments have already been, because you already linked it earlier. So this has been filled up now and it becomes 0 towards the end. So yeah, that's how sculpting would work. So if people who have 3765205 number in the total debt service, can they type yes, why in the chat box, please, that you have reached 3765205 as well on your sheets. Basically, you should have 2.4 million as your principal and 1.365 as your interest. Okay, great. Okay, any questions here before we move on? Any questions on the debt sculpting? And up to the class, like, do you want to go through the debt term sheet or would you rather have a Q&A session now? Because I'm conscious of the time as well. If you prefer a Q&A session, then we can do that instead of going to the debt term sheet. Okay, so guys, just type your preference, Q&A or TS term sheet, QA or TS. I'm making short forms on the go. Okay. So let's go ahead to the debt term sheet part then. I think people, it's good that everything is clear to people, so that's good. Okay. Okay, now debt term sheet. How many of you have actually seen a debt term sheet? I hope majority of class has seen a debt term sheet before. Yes. Kent, do you have a question or was it a yes? Okay. Okay. So typically a debt term sheet essentially has the basic terms and conditions under which a senior debt financing would be governed, right? And a debt term sheet contains important aspects of a deal without going through a lot of minor details like the exact clauses, and it lays the groundwork so that all parties involved in the transaction agree to major aspects of the deal. Debt term sheet is always the first step in negotiating a final set of financing documents because the basic terms would be laid out there. And when I say the basic terms, I think it would be good to learn how to summarize a debt term sheet, because if you have a specific format, or if you understand that what things are important in a debt term sheet, then you would actually look for that, because debt term sheet can be as short as 5 pages to as long as 15 pages as well in some cases, because there may be a lot of conditions that are being put in debt term sheet. So it's always good to focus on the important aspects first to make a very quick summary of what's there, and then go into really the details. So I have listed down some of the things that I feel are important for a debt term sheet summary that should be covered at a basic as a minimum. But you, of course, you're happy, if you want a more detailed summary, that of course, the idea is that a summary should be shorter than the term sheet itself. So that's the whole idea of making a summary. Yeah. Okay. So typically in a debt term sheet, you would have these covenants, right? You have a loan amount, pricing fee, drawdown requirements, loan repayment profile, reps and warranties, covenants, financial ratios, default covenants, right? And I have also explained them here. So what essentially all of these means, right? A debt sizing means the estimated debt amount needed for project finance. The price of the fee is basically the cost of funds. What are the base rates? What is the margin, hedge requirements, if any? The drawdown requirements, meaning when does the work, when the debt facility is available and how it is being drawn down. Pro rata or equity first. The repayment profile, financial ratios or covenants, very common, like minimum DSCR. Someone talked about LLCR as well. So yeah, for the minimum covenants. Reps and warranties are the assurances given by SPV as a precondition to receiving the funds, meaning these assurances can be in the form of that, okay, the sponsor is aware how to do the project itself. They have the necessary capability. They are going to the right EPC contractors. They have the right technology, right? So because there may be some reliance, when the lender is giving loan to the sponsor, although there's a part of the due diligence, but whenever a due diligence is done, it is done based on the information provided by the sponsor itself. So the idea is the basic reps and warranty clauses that all the information that has been provided is true to the best of the knowledge of the sponsor, right? That they're not providing any false or many misrepresentations while securing debt for the project. List of security arrangements agreed by the SPV against the debt. So if you have, like, typically all the project finance assets would be pledged, or would be the security over those assets would be transferred to the lenders throughout the loan tenor. Reporting and monitoring. So there are these operational parameters or KPIs that would be reported to lenders to monitor the project. So besides your governance, like DSCR, LLCR, DESRA accounts, so these are the financial governance, right? That would be reported to lenders on a quarterly basis or on a half-yearly basis. But besides these financial governance, there may also be operational parameters that would need to be reported to lenders, so that lenders' technical advisor can check that the project is going in the right direction. So for example, for a water desalination project, it might be the quantum of water produced, the quality of water being produced. Similarly, in a waste treatment plant, it can be the end use of that recycling material. Because if you have committed something that is be recycled, but you're actually dumping into the ground, then that's not as per, you're not going by the concession agreement. So there might be operational parameters or KPIs defined by lenders, which are very, very project specific. This is not typical for all the infra projects and not at all common for very typical infra projects like road projects or power projects, which are very well understood. But for new technologies like battery storage projects, for hydrogen projects in energy, for school projects, school infra, urban infra, some of these KPIs might be mentioned. And then the default events. So you would have a set of default events already in the concession agreement if it's in a PPP project. So a lot of these default covenants are replicated in the term sheet as well, in terms of concession and default especially. So this is the typical content of a term sheet, but then when you create a summary, right, I would encourage you, based on my experience, it's always very important to focus on the first 5 things that you see on the screen: the sizing, pricing, drawdown, repayment profile, and the covenant. So that's the first 5 things. and security arrangements, right? Again, you should be able to prepare a very quick summary of these items. In the loan repayment profile, you don't have to, when the term sheet might have a full quarterly repayment profile for over 20 years. But when I say repayment profile summary, I think what I want to imply is that you should be aware what kind of repayment it is, whether it's equal principal, whether it's EMI, and even if it's sculpted, whether it's a fixed tenor sculpting or a flexible tenor sculpting. So you should be, or a DSCR sculpting. The flexible tenor sculpting is also called DSCR sculpting. So what kind of sculpting is being done so that you are very clear whether that repayment profile is suitable for that project or not. So yeah, I think just note this down, like, these are the 5 things that you should have a look at, and security arrangements. Yeah. Uh, I think I had a couple of more slides around explaining the interest rate. Let me very quickly go through it because this might be also useful when you're reading a term sheet. When you talk about this pricing and fee, right, you would have an interest during construction. And as you can see in a file as well that we are working on, the interest during construction is a lower number, it's 0.18% every quarter. So that's 3.25% during construction, and then during operation, it's a higher number, right? It's 6.55% during operation. So typically you would see that in the projects as well, that IDC, interest during construction, is a lower amount, which is then rolled up and added as part of the project cost. There's a backdated interest in some projects, meaning lower initial years, but then stepped up towards the end of the tenure, right? So this is typically a case. In these cases, typically the debt would be refinanced. So before the higher interest comes in, the sponsor would actually refinance the debt. So that's back-ended interest. There's a uniform interest margin, meaning you always have treasury bonds plus XX%, so that's a fixed treasury, fixed margin over a base rate. Most common, you would see that. And when I say back-ended interest, even the other cases, is just the margin that changes over the period of time, but you would always have a base rate. Front-ended interest is for higher risk projects, for new technology projects, wherein the lenders want to earn a higher interest during the initial start because they're taking that risk, and then you go to the lower rate going forward once the project has shown operational capability. And again, when we talk about the security package, right, as I said, this is something that you should classify. And again, these can be very long clause in the term sheet. So when you make a summary, right, you should know what kind of security arrangements we're talking about, right? And these are the broad categories that I've listed for you that you would typically see in a term sheet: either a security over SPV shares, parent company guarantees, income and minimum revenue shortfall guarantees, project completion guarantees. They can be a prepayment of loan for certain milestones, for achieving certain milestones. For example, in a market risk project, if you reach 80% of the loan capacity, then you can repay the loan, right? A letters of comfort or procuring agency. So this is very common in developing Asian countries, wherein there's a FX risk, for example. So there's a letter of comfort required from the Ministry of Finance. Step-in rights, insurance, etc. So these are the typical securities. If, for example, lenders may want you to procure an insurance during the operation period, right, for a certain amount, which may be equal for 6 months of revenue or 12 months of revenue. What if your off-taker doesn't pay? Then you should have insurance so that you get the money, and in turn you can pay the loan, right? That's the insurance amount that they can ask for. So just maybe, again, these are the very common kind of security arrangement that you would see in a term sheet. So again, when you're summarizing a term sheet, always kind of think about in these terms, rather than just copying the clause which is in the term sheet. You can actually think about some of these terms when you summarize the term sheet. But yeah, so yeah, that's all. That's all on the questions. I understand there might be some questions, right? So I would suggest if you can send in your questions to our email ID, then I would be very happy to answer. And I'm available for the next 10 minutes. If someone wants to ask a question, of course, we can answer that as well. I was also hoping if I can ask people to switch on their camera, we can take maybe a joint photograph for the class. That's okay. Yeah, let me just put this in the together mode. Okay. So yeah, Walid, you have a question, the recording. Yes, we will send the recording. So the recording would also be posted on our YouTube channel. So we will be sending a link to all the participants so that they can actually register as well. Okay, so let me just very quickly ask the admin. Can I request the admin guy to please take a very quick photograph, please? Yeah. Yeah. Thank you everyone. Thanks for attending the session today. I hope it was useful, and if I hope to see you in future classes as well that we'll be hosting. Yeah. Thank you. Thank you all. Take care.